In this video, we're going to talk about Federal Reserve policy and how it affects mortgage rates. There's a misconception about the federal funds rate, which is the publicized rate everybody reads about and what the Fed cuts or increases. That is the rate for overnight loans between banks and therefore doesn't directly affect the 30-year interest rates for mortgages or the 15-year rate for mortgages. Here's an example of the daily price chart of a bond that's referred to as a mortgage-backed security. Since the creation of Fannie Mae and the Federal Housing Administration, mortgages have been packaged together each month into a bond, meaning that a buyer of a bond is buying a small slice of 20 to 30,000 or even more mortgages. Each month, as homeowners make their mortgage payments, most of the interest is paid to the bondholders. If you own any share of a bond fund in your 401k, IRA, you very likely own a tiny slice of a bunch of mortgages. Here I'm showing the Japanese candlestick chart. This is the daily trading chart for what's called mortgage-backed securities. The relationship between this bond and mortgage rates is that as mortgage-backed security rises in price, interest rates decline. So on this chart, green is good, and then red, as prices go down, that's bad. Mortgage rates go up. It's an inverse relationship. So you'll see on August 22nd, let's take a quick look at this day here. On August 22nd, 2025, the Federal Reserve Chairman gave a speech that kicked off the rise in the bond prices. You can see all this green. That's good. This was the first time the Fed chairman really strongly iterated that he was in favor of a cut. Buyers of mortgage-backed securities anticipated the cut, so the mortgage-backed security rose in price approximately a month before the actual cut here on September 17th. Now, you can see the market thought maybe the wording of his statement wasn't strong enough. So mortgage rates got worse. Mortgage-backed security pricing went down. Another example, let's take a look at October 29th. This is an important date. So this was the day of the next Federal Reserve meeting. The market was hoping that the Federal Reserve would renew buying of mortgage-backed securities, these bonds. That ended up not being the policy, which caused a sell-off in the bond and mortgage rates rose. You can see red is bad. So since October 29th down to November 17th, mortgage rates got worse. So in summary, the Fed funds rate, the overnight lending rate, doesn't affect mortgages directly. Now, if you have any questions about this or an upcoming Federal Reserve policy change, feel free to reach out. I would love to hear from you.